Imagine waking up and realizing the biggest wealth transfer of your lifetime is already underway, and you missed the first half because you were busy arguing about meme coins on Twitter. The U.S. is quietly moving to reset how trillions of dollars flow through the system. Crypto is right in the crosshairs, and about $37 trillion of value is effectively up for renegotiation. And yes, it's happening right now, not in some vague 2030 future. Welcome to the comment section with Thomas Paul, where we try to make sense of the financial circus before the clowns set monetary policy. Today we're digging into this so-called $37 trillion crypto reset in the U.S., what it actually means, what's real versus hype, and most importantly, what you should be watching as an investor so you don't end up holding the bag while Wall Street and Washington split the spoils. And the wild part? The reset is already in motion. Not if, not someday. It's mid-download. So let's unpack it. First, let's define what we're even talking about when we say $37 trillion reset. That number roughly lines up with the total value of retirement assets, institutional portfolios, and broader financial wealth that could, emphasis on could, get partial crypto exposure over the next cycle as regulation, infrastructure, and political attitudes shift. We're not saying $37 trillion is going to YOLO into Solana NFTs. Calm down. We're saying the rules of the game for how that capital is allocated are being rewritten around three pillars: regulation, institutional access, and digital infrastructure. And here's where it gets interesting. On the surface, it looks like the usual noise. Crypto prices bouncing, politicians tweeting, regulators doing their favorite activity, being confusing. But underneath, you've got governments trying to maintain control over the monetary system. Big finance looking at crypto like, how do we take this casino and turn it into a regulated theme park where we own the ticket booth? Tech building rails that make traditional finance look like it's running on dial-up. That tension, that three-way tug-of-war between politics, Wall Street, and technology is the reset. And if you're an investor, you're basically being forced to choose a lane. Ignore it and hope it goes away, trade the hype cycles, or actually position yourself for what happens when the big, boring, slow money finally arrives. But wait, it gets even wilder. Because this isn't just about crypto going up or down. It's about the U.S. deciding how much of the future financial system it wants to own, and how much it's willing to share with decentralized networks it can't fully control. So let's walk through the key takeaways of what's happening right now behind all the noise. Key takeaway number 1, regulation isn't coming. It's here, and it's uneven on purpose. In the U.S., you've got agencies arguing over whether certain tokens are securities, commodities, or just unregistered fun. One state says, we love innovation. Another basically says, touch a stablecoin and we'll see you in court. That confusion is not an accident. It slows things down. It keeps retail guessing. It lets institutions move in carefully while everyone else is still asking, is this legal? Politicians, especially in election cycles, love to talk tough on crypto while quietly approving things like spot Bitcoin ETFs in the background. Because nothing says we hate crypto like giving Wall Street a clean, regulated way to sell it to your pension fund. So on one hand, you see enforcement actions, warnings, and lawsuits. On the other, you see more clarity on custody rules, ETFs, tax treatment, and how banks can interact with digital assets. The message is basically, you, random individual, proceed at your own risk. You, massive institution, let's talk. We'll write you a rule book. This is the first part of the reset. Crypto is being dragged, kicking and screaming, into the existing regulatory machine. The Wild West phase is closing. The airport security phase is beginning. Second big takeaway, the infrastructure for institutional money is already built, or very close. Custody services that meet institutional standards, they exist. ETFs and trusts that let big funds buy exposure without touching private keys, already launched or in advanced stages. Derivatives, options, futures, lending products built on top of crypto. Check, check, check. We're moving from crypto is this weird parallel world to crypto is just another asset class on your brokerage screen, next to boring bonds and sad-looking REITs. And here's the crucial point. Institutions don't need to believe in number go up forever. They just need a narrative like non-correlated asset, digital gold, or portfolio diversifier to justify putting in a small percentage. And even a small percentage of institutional allocation, spread across retirement funds, endowments, sovereign wealth funds, family offices, That's where this $37 trillion framing comes from. It's not about all of it moving. It's about what happens when just 1 to 3% of that pool touches crypto over a few years. You won't believe what happens next when boring money gets a tiny bit adventurous. Third takeaway. The U.S. is in a geopolitical arms race with blockchains. Here's the uncomfortable truth. If the U.S. pushes crypto too hard offshore, innovation doesn't die. It just moves to friendlier jurisdictions. Other countries are already experimenting with more flexible frameworks, central bank digital currencies, and tokenized assets. The U.S. doesn't want to lose dollar dominance, but it also doesn't want to fully embrace something it can't completely control. So what do? You try to domesticate it. That's why tokenization is becoming the magic word. Tokenize treasuries, tokenize real estate, tokenize funds. You keep the underlying asset in the old system, but you use blockchain rails for speed, transparency, and 24/7 markets. This is the compromise future. Not crypto replaces everything, but crypto rails quietly run everything under the hood while the front end still looks familiar. And that leads us to the final big takeaway. The reset isn't about Bitcoin versus the dollar. It's about how value moves. Right now, you live in a world where wires take days, markets close on weekends, and sending money across borders feels like a tax audit. Crypto rails don't care what time it is or what country you're in. They just move value. That is what the big money wants to tap into, without losing regulatory control. So, politics is trying to throttle the chaos. Finance is trying to package it. Technology is trying to make it inevitable. That's the reset. Now let's talk about what this actually means for you as an investor, because the point isn't to sound smart at dinner parties. The point is to not get wrecked while the rules change. First implication, volatility is not going away, but the players will change. Retail-driven hype cycles? Those aren't dead. They're just getting overshadowed by slower, bigger flows. Regulation headlines, enforcement actions, and political soundbites will still drive short-term crashes and spikes. But over time, you're going to see more of the price action shaped by ETF inflows, macro trends, and institutional rebalancing. That means if your entire strategy is, I buy when Twitter is euphoric and sell when it's depressed, you're basically playing checkers while the rest of the table upgrades to 3D chess. You need to watch ETF inflows and outflows, policy speeches and committee hearings that hint at stricter or friendlier rules, big banks and asset managers quietly building crypto divisions. Because institutions don't tweet, I'm super bullish, fam. They just start hiring. Second implication, the gap between casino coins and infrastructure assets will widen. In a regulated institutional world, not all tokens are created equal. Assets with clearer narratives and regulatory paths, like Bitcoin as digital gold or large smart contract platforms as digital infrastructure, are much more likely to become core holdings. Meanwhile, the long tail of speculative tokens, they might pump, they might dump, but they'll live further on the fringe as regulatory spotlight intensifies. Think of it like the early days of the internet. You had the foundational protocols and the pets.com of the world. Some made it into permanent portfolios. Others made it into history memes. As this $37 trillion reset plays out, the market will be forced to differentiate between assets that institutions can hold, assets that regulators tolerate, assets that are one letter away from a subpoena. So as an investor, ask yourself, if a big pension fund CIO had to justify holding this token in front of a risk committee, could they do it with a straight face? If the answer is no, maybe don't make that 80% of your net worth. Third implication, time horizons matter more than ever. Over the next year or so, you'll probably see chaotic regulation announcements, court cases that change how certain tokens are classified, election cycles where candidates flip-flop on crypto to chase voters. All of that is short-term noise that can absolutely smash prices in both directions. But zoom out a bit. Over multiple years, as rails get built, as products become standardized, and as crypto gets bundled into boring financial products, the story becomes less casino and more infrastructure. That's where long-term positioning makes sense, focusing on networks that are most likely to be integrated into traditional finance, survive regulatory tightening, capture real economic activity, not just speculative trading. Let's be clear, that doesn't mean guaranteed upside. It just means you're playing the same game as the people who actually move the $37 trillion, not just the people posting rocket emojis. And here's where things get really interesting for strategy. You basically have 3 lanes to think about. Lane 1, conservative exposure. This is your I believe in digital assets, but I also like sleeping at night lane. Think ETF exposure, Bitcoin, maybe one or two blue chip platforms once they have clearer regulatory treatment. You treat it like a small satellite position in your overall portfolio, not your entire identity. Lane 2, infrastructure and picks and shovels. Instead of trying to guess which individual token wins, you invest in the companies, exchanges, custody providers, and technology platforms that make the whole system work, especially the ones that are already publicly listed or heavily regulated. If the crypto economy grows, these guys win even if one specific token faceplants. Lane 3, speculation, on purpose. This is where you put a small, clearly defined slice of your capital into higher risk, higher upside projects. DeFi experiments, smaller caps, early stage networks. The key word is small. If you're managing this lane with your emotions instead of preset rules, you're not investing. You're live streaming your own nervous breakdown. The reset doesn't mean go all in. It means pick your lane, set your rules, and actually respect your own risk limits. So what should you watch next as this plays out? First, watch the legal and regulatory calendar like it's earnings season. Key hearings, court rulings on whether certain tokens are securities, new guidance on stablecoins, tax treatment, and KYC requirements. These are not background noise anymore. They're literally the rules of the game. Any framework that makes it easier for institutions to touch certain assets is bullish for those assets, even if the headlines sound scary at first. Second, track real adoption, not just narratives. Are more treasuries being tokenized? Are more traditional assets moving on-chain? Are major payment companies or banks quietly using blockchain rails in the background? If the underlying technology is actually getting used, that matters much more than whether one influencer changes their profile picture to Bitcoin Maxi 1987. Third, follow the money, not the memes. Where are ETFs seeing net inflows? Which regions are opening up or cracking down? Which sectors, payments, gaming, tokenization, DeFi, are getting institutional interest? When boring capital flows in, it usually doesn't scream about it on social media. It just starts buying. And yes, keep an eye on politics, because we're now in a world where a few key political decisions can either unlock a wave of new products and access or slam the brakes on entire segments of the market. Crypto has graduated from niche internet toy to thing that shows up in policy memos. That's both scary and incredibly important. So let's bring this home. This so-called $37 trillion crypto reset is not some magic switch that gets flipped one day. It's a long, messy, political, financial, and technological process where crypto gets dragged into the regulated world. Institutions get cleaner ways to own it. Blockchains quietly become part of the plumbing of the financial system. Along the way, a lot of people will make a lot of money. And a lot of people will learn very expensive lessons about leverage, regulation, and thinking a TikTok video is due diligence. Your job is not to predict every twist. Your job is to understand the direction of travel. We're moving from, is crypto legit? To, how much and under what rules? Is this allowed? To, what structure do we use? Will it be regulated? To, here's the framework, adapt or die. The opportunity is enormous, but so is the risk if you treat this like a game instead of a structural shift. So ask yourself, where do I want to sit when the dust settles? Do I want to be all-in casino, all-in boomer, or actually have a strategy that survives regulation, elections, and institutions joining the party? Because make no mistake, they are joining. Slowly, carefully, and on their own terms. The reset is happening with or without your permission. Now I want to hear from you. Do you think this whole $37 trillion reset idea is overblown marketing? Or are we massively underestimating how much capital will eventually flow into digital assets once the rails are fully built? Drop your hottest, spiciest, most unfiltered take in the comments. Are you positioning for this, sitting it out, or just here for the chaos and entertainment value? If you got value from this breakdown, hit like so YouTube knows you prefer content with more numbers than dance challenges. Subscribe to the comment section with Thomas Paul for more deep dives into the weird love triangle between politics, technology, and your portfolio. And if you made it this far, you're officially in the 1%, not of wealth yet, but of people who actually try to understand what's happening before it hits their wallet. Thanks for hanging out, and I'll see you in the next one.